Welcome to the first DeFi session by Icoinic and ITI. Today is the first time that we're doing this. The first topic that we're touching on is the introduction to automated market makers, one of the key building pieces of decentralized finance. So for today, I'm going to start with the basics, just a brief overview of DeFi, what it is, what has it become, where did it come from? Then we'll describe the role of AMMs and decentralized exchanges in this whole new industry. And at the end, we'll give some practical examples. We'll take about 20 minutes to do the introduction, another 10 minutes of practical examples. And at the end, we have about 15 minutes for questions. A quick summary of what is this whole blockchain thing again, because it's important to understand the role that it plays. I assume everyone here already knows a little bit about blockchain. So it's a public database that is distributed over a network of computers that facilitate and records transactions in the absence of a third party. You could see it as a big global database that's collectively operated and owned. It creates trust between strangers. By doing this, it disintermediates trust between third parties. Essentially, especially 3-4 years ago, people were saying everything is going on a blockchain. Every third party is going to get cut out. That's not really the case, but we do really see where the aspect of trust is created by these blockchains. I think the best example is how these digital assets like Bitcoin can operate on a blockchain without needing any specific centralized party. Now, that doesn't mean that it's always super decentralized. To give you an example, Bitcoin mining was usually centralized in China with about 60 to 70% being mined there. But it does mean that this network is global and anyone can participate in it. Blockchain has created a shift from what we traditionally know as Web 1 and Web 2 to what we now know as Web 3. So Web 1 was this read-only web where there was internet, but you could only read what was on websites. It really enabled this information age, this information economy where websites like Wikipedia really flourished. Then in Web 2.0, we were seeing this read and write internet. You as a user can also participate in the internet by writing, uploading YouTube videos, uploading Facebook content. This created this platform economy, but these platforms were still owned and operated by a higher party like YouTube or Facebook or whatever. Now, because of these trust networks, because of blockchains, we're now able to create what we call Web 3.0, an internet that allows you to read, write, and execute. This means that you as a user cannot just only participate and read what's happening, but you can also operate things on it. You can even own a piece of it. This started this token economy concept that's really at the middle of blockchain and DeFi innovation. It now allows individuals to truly own and monetize on their data. And this concept of data is really important. If you look at the evolution of kind of blockchains and how they have come to the state where we are now, 2020, 21, with decentralized finance, it's really important to understand the innovations that got us here. So at start, there was Bitcoin, what was supposed to be a peer-to-peer electronic cash, what was developed during the kind of recession of 2008 as an alternative for needing all the big banks and the traditional financial infrastructure to facilitate transactions between people. On this innovation, other cryptocurrencies were created. For example, Litecoin. It still used the same concepts of Bitcoin, it being a digital money, a digital equivalent of a euro or a dollar, but then not tied to any nation state or specific banking infrastructure. These simple cryptocurrencies continued to emerge until 2014, where then people started to think about further implications of the blockchain technology. What else can we do beyond just keeping records of who owns what and sending from A to B? This was first introduced with Ethereum, which was the first smart contract platform. A smart contract is a line of code that runs on a blockchain and can execute more complex transactions. To give you an example, the Ethereum platform created what some of you may know, the ICOs, the initial coin offerings. It allowed projects to use the blockchain infrastructure to do more complex financial transactions. And in this case, it was doing a crowd fund or a crowd offering. Especially in 2016-17, these ICOs were a big boom. Everybody was talking about blockchain. Everybody was trying to take a grain from it. But these applications were still relatively simple. It were simple community offerings that did have, of course, it did have merit in it because we opened up this kind of crowdfunding mechanism to the wide world. But it was far from what we now see being built on blockchains like Ethereum. Especially during the kind of what you call the bear market of 2018-19, developers started to really push the edges of what we can build on a blockchain. And this started to come together early 2020, when we for the first time saw this emergence of this decentralized finance ecosystem. And what is decentralized finance? So decentralized finance refers to financial services that are built on public blockchains. These are open protocols, they're all decentralized, and anyone can access them and utilize them without needing a central intermediary. Now, the difference between just a payment system or digital money like Bitcoin or a DeFi or decentralized finance application is in the way that it's layered and the functions that it has. So if you look at this image here, you can see that at the bottom of this DeFi technology stack, there is the settlement layer. The settlement layer are the underlying blockchain infrastructure that creates this trust network, that creates this database that people can access and trust. Currently, the main settlement layer is Ethereum. It's the largest one and the one that's most secure. There are also other settlement layers, for example, Solana, Polkadot, that are also attempting at creating this global trust machine that secures the states of the network. Now, once you understand that the settlement layer is truly global and extremely secure, it's being secured by billions of dollars of processing power, then on top of this settlement layer, you can build assets. For example, the native assets of Ethereum being Ether, but you can also tokenize assets. For example, tokenizing a house. So creating a digital equivalent of that asset and putting it on a blockchain. Another concept that's really gained popularity and adoption is stablecoins. Stablecoins are essentially taking or locking up an amount of fiat, for example, US dollars, in a bank account or in a vault, and then locking it there and bridging it on a blockchain, which moves this stablecoin, this value, from the settlement layer of the traditional banks, for example, from the Swift network to the Ethereum network. So really using the blockchain as a global settlement layer, just like you would use traditional financial settlement layers. Another concept is wrapped assets, which are assets that you take from one blockchain, you lock it there, and you move it to a different settlement layer. Oftentimes, or one that's really well adopted, is the wrapped Bitcoin, where you lock Bitcoin on the Bitcoin network, and then you move them to the Ethereum settlement network. And what you do with this is that you can then benefit from all the utilities that are built on Ethereum, while still having price exposure and asset of the underlying Bitcoin. So a lot of people that were extremely bullish on Bitcoin or preferred Bitcoin as their asset would still be able to participate in the Ethereum ecosystem, which created a lot of value. I believe right now over 2 to even 3% of all Bitcoin lives on the Ethereum network. And it really shows the power of these settlement layers to be valuable. Now, the real important part is the layer that comes above that, the DeFi protocol layer. That's the part that we're zooming in on today. So these are different financial applications that were built using smart contracts. For example, decentralized exchanges. These are exchanges that facilitate the transfer and exchange of tokens without needing a central intermediary. So without needing a Kraken or a Coinbase or a Binance, people would still be able to swap one asset for another. Another use case is borrowing and lending. Just like in traditional finance, people take out loans, other people are providing funds. This is also being rebuilt on in decentralized finance, where you can now lock up your collateral in the form of, for example, Ethereum, and take out a loan in, for example, stablecoins. Another use case are derivatives and synthetic assets. For example, you can have a multiplier, a 4-time long position being created in a DeFi protocol. You can also create options, futures, anything that you would be able to create in a traditional financial system or traditional settlement layer can now be recreated with code. And there are a couple benefits to this code. One, it's open source in the sense that anyone can access it and see the information. It lives on this one settlement layer, which is really important because that means that there's only one source of truth. That makes it also much easier for accounting and for linking up systems. There will never be two different versions of reality. This also means that all these applications, because they share the same infrastructure, they can connect almost seamlessly to each other. So your decentralized exchange and your insurance platform are connected to the same foundation. They're sharing the same standards, and that makes them highly interoperable, meaning they can connect to each other. And this allows for an environment that has very little friction between different applications. Again, they're open source, they're accessible, and now also they're extremely useful and composable. So by combining this, you get a whole new paradigm for finance. Over the past years, DeFi has grown from a small $1.5 billion sub-industry of crypto assets to what is now over a $50 billion industry. This image over here shows you the different niches that have emerged. It goes all the way from derivatives to asset management to trading, and the things that I just mentioned before. Today, we're going to zoom on specifically on the decentralized exchanges and the concept of automated market makers. So it's the section in the blue circle over there. So automated market makers are the underlying technology that have really enabled decentralized exchanges. A couple of limitations maybe to this settlement layer that you see here is that the Ethereum blockchain is relatively slow and doesn't have a large capacity. On average, it takes about 10 to 15 seconds for a new block to be created. This means for a new set of transactions to be added to the blockchain, which is far from instant. So it really takes 10 to 15 seconds for your transaction to be completed. And on top of that, there's limited capacity in the blockchain. So you also have to pay sometimes a hefty fee for including your transaction. Sometimes it goes as high as $50 to $100 for adding one single transaction. So there are a lot of limitations here. And automated market makers have emerged to recreate these exchanges while still allowing these limitations of the settlement layer to be taken into account. So what is an AMM? It's also referred to as a liquidity pool. It essentially is a pool of tokens that are locked in a smart contract that facilitate trades. It was popularized by Uniswap, but it already exists for about 2.5 years. It was first created by Banker. As of today, about 5% of all crypto asset exchanges happen in a AMM decentralized exchange. That's about $10 billion of volume each day passing through these applications. One of the big innovations of AMMs are that they're permissionless. That means that anyone can interact with them. It also means that anyone can create a pool or a market inside of an AMM. One of the biggest innovations there that it enabled a long tail of tokens to create markets. As an example, Coinbase only has 70 different tokens listed on their exchange, while Uniswap, the biggest decentralized exchange, has 2,300 tokens. Just think of that, the amount of friction that's removed there. If you have a small token, let's say you have a project with a market cap of $1, $2, $3, $4 million, there's no exchange that's going to be able to list them on their platform. And if you are lucky enough, then you still need to pay a hefty fee. You need to find people that are willing to be market makers. And this creates a lot of friction. So in traditional markets, maybe it's good to highlight, market makers are individuals that provide both the buying and the selling side of markets. They increase liquidity, so they increase the ability for an asset to be exchanged, and this helps traders get better prices. In traditional markets, this would be done in order books, like you see on the top right image. Order books allow buyers and sellers to place specific orders at specific price points for specific amounts. So if you look at the left side, you see the green bars in the back. It shows the orders that are placed in the market. People are willing to buy an X amount of Bitcoin for an X amount of US dollar, for example. On the other side, you see the red bars. Those are the people that are willing to sell at a specific price point. Now, once the red and the green bars kind of meet in the middle, that's where a trade happens. Now, let me explain to you how this happens in an AMM or in a decentralized exchange. There are, again, two stakeholders that you need to take into account: the liquidity providers or the market makers, and the traders, the people that are actually swapping one token for another. The liquidity providers deposit an X amount of assets, let's say 10 token A and 10 token B, into this pool, this liquidity pool. As an output, they get an ownership percentage of this pool. So for example, in this example, there are 12 pool tokens, and this one liquidity provider gets 4 of these tokens. They're called LP shares, so liquidity provider shares. When a trader comes in, he places an order of, hey, I want to swap 10 token A and I want to get out 1 token B. Now, for facilitating this trade, the liquidity provider charges a fee. In this case, it's 0.03% of the trade. So the trader is able to swap his token A to a token B and pays a small fee in exchange. And this fee is then earned by the liquidity provider. One important concept to understand here is the concept of impermanent loss, which is the loss of being a liquidity provider opposed to being a non-liquidity provider. A good example of this would be, would I have been better off if I just held these two assets, so let's say token A and token B, for a year, opposed to providing it to this Uniswap pool and getting these fees? It's called impermanent loss because it only becomes permanent the moment you close your position and move out of it. A simple kind of calculation to understand if it's worth it to become a liquidity provider and participate in AMM is seeing if the impermanent loss is smaller or equal to the collected fees and the rewards earned from the platform, and anything above that is profit. So here it mentioned collected fees plus rewarded governance tokens. And especially the latter part is something that I want to zoom into. Because going back to this kind of slide of Web3, it's now possible for people to own a piece of the infrastructure that they're using. It's like owning a share of Facebook and getting more shares every time you create a picture that gets 100 likes. To decentralize the power and to distribute the ownership to the early users, these DeFi projects are often rewarding their early users with governance tokens. And governance tokens allow the holders of them to have some influence over the protocol, whether this is the development roadmap, whether these are the protocol fees, anything that could be changed with code, which is almost everything, can be governed through tokens. And that's really weird. It's something that we haven't seen before because traditionally companies are built on a lot of human relationships. They're not as built on pure technology as these DeFi systems. So it's truly for the first time ever that we're seeing this new asset class, these governance tokens that directly influence how a protocol or organization rules and runs. So let's get a little bit more practical and give you some examples of different types of AMMs that are out there. I'm going to highlight 3 key ones that have been dominant for the first half of 2021. The first one being Uniswap version 2, the second Curve version 1, and the third Balancer version 1. And it's really interesting to see the differences and the similarities between these protocols. Again, a automated market maker is a pool or a function that provides liquidity to a market. It makes a market, but there are different ways for doing that. Uniswap, for example, has pools that only exist out of 2 assets. So for example, US dollar and Ethereum. These are fixed. The trading fees are also fixed. It's always 0.3%. So every time a trade happens, 0.3% of the value is sent to the liquidity providers. And the token weights are always 50% of asset A and 50% of asset B. These are very simple AMM models and are also quite limited in the different ways that you could use it. But it also makes it super simple. It makes it understandable for people. It makes it simple to create. You don't have to have extremely deep knowledge to create a Uniswap pool. You can literally take two assets that you believe are similarly valuable and will be going up or down together and provide it into a pool. Now, Curve version 1 is a AMM that's optimized for stable assets, so the stable coins that I mentioned. This means that the function, so the calculation, is made in a way that it optimizes for trades between tokens that have the same value. To give you an example, there are at least 10 different stable coins that represent the US dollar. So inside of Curve, you would be able to swap your USDT, so the Tether US dollar, to the USD coin from Coinbase with almost no trading fees. So in this case, it's only 0.04%. You can already see that this is much lower than in Uniswap v2. Another benefit of it is that you cannot just only put one token in there, but you can put up to 4 tokens in there. So we could create a market between USDT, Binance US dollar, USDC, and it would automatically allow trades to happen between these assets and only charge a small fee. And the reason why the protocol can charge this small fee is because the prices stay the same. So there is almost no risk that the assets that you're holding are going to lose value relative to each other. Now imagine this being part of like a Forex exchange in traditional finance. Imagine having a curve that allows you to swap your US dollars to a token or a fiat that is tied to the US dollar. Let's say the Antillean guilder. I myself am from Curacao. We have a fiat currency that's backed by dollars. So imagine being able to transfer your US dollars to Antillean guilders with only paying 0.0% exchange rate. That's ridiculous. Right now, the exchange rate is almost 1.5%. But imagine if this was available, the amount of friction that gets removed. So that's how Curve works. It's these trading fees and the tokens in the liquidity pool are already fixed. It's not something that you can change later on. It's not something that you can play around with too much. Another option are taking Balancer V1, which is a more flexible market maker. With flexible, it means that the market can be changed over time. To give you an example, you can put 1 to 8 tokens into a Balancer pool. So you could decide to only put Bitcoin and Ethereum in there, but you could also decide to put 5 or 6 or 7 different assets into one pool. The trading fees are also flexible. You can decide yourself if you want to have trading fees of 0%, or if you want trading fees of 1%, 2%, 3%, whatever. And it can also be, again, governed by liquidity tokens. This means that while this pool is live, it can be updated by voting. This is another big revolution if you compare it to, for example, Uniswap, where maybe in times of high demand, you would want to actually raise your trading fees because individuals are going to make these trades regardless and earning more for your liquidity providers. So I made a simple checklist for people to use or at least think about before they even consider participating in AMMs. It's a couple of questions that you need to think about before you take a position. First, you should ask yourself, the assets that I'm going to put into this pool, do I believe that they're going to grow in value or decline in value? And if so, in what time frame? If you go back to the example of this, I actually have a better example here. But do you think that these assets that you're going to provide into this liquidity pool that are going to grow or shrink? And if so, again, on what time frame? If you think that, for example, the price of Ethereum is 1900 today, but I believe that in a year from now, it's going to be $10, it would have been better for me to not provide liquidity. It would have been better for me to sell this asset today and not touch it anymore until it reaches $10. But maybe I think that, hey, I think Ethereum is going down a little bit, but eventually it's going up again. And that in 1 year from now, it would have gone down to $1,000, but also came back up to 4,000. Then this is definitely the asset that you can consider for your time frame to hold. Next up, do I believe that these assets that I'm going to keep in this pool, that they're going to keep the relative value that they have? This relates to the impermanent loss. Do you think that the relationship between token A and token B will stay relatively similar? And this goes kind of into more complex mathematics. And in a bit, I'll give some simple examples. But there are also tools available that I'll share after this presentation that you can play around with to visualize kind of the assumptions that you're making. But do you believe that token A and token B will have a similar relative value? So to give you an example, imagine 1 Bitcoin is worth 10 Ethereum today. If I believe that these assets will keep this balance 1 to 10, it's perfectly fine to provide liquidity because I don't mind buying or selling any of them because eventually they're getting back to this initial distribution. Now, if I think that Bitcoin is going to outperform Ethereum by 10 times, then I would be better off just holding 100% Bitcoin instead of having 50% in Ethereum and 50% in Bitcoin. Can imagine if I only get, because I only get 50% of the upside benefit. Same goes for the downside risk that you're taking as well. If I think that Ethereum is going to, again, go from $1,900 to $10, I would rather not provide that asset into a liquidity pool. So you really need to ask yourself this. And then, do I believe, once I've defined kind of what the risks, what the potential rewards are, then do you believe that the risk that you're taking on that specific time frame, that it's worth it? Do you believe that this is justifiable and that you'll be able to get more returns at a somewhat predictable level by being a liquidity provider, by participating in AMMs? And that's kind of where you get to this part. The impermanent loss should always be smaller or equal to the collected fees and rewarded governance tokens. And that's when you take home a profit. I have 2 simple examples of one, a Uniswap market, how it would look like and how it would function, and also a balancer market that I'm going to walk through. Starting with Uniswap. So imagine we have this pool with two tokens in the pool, sorry about that, and trading fees of 0.3%. I'm going to provide USDC for 50% and Ethereum for another 50%. Now, the assumption, like the best case scenario for me, would be that the price of Ethereum and the price of Ethereum is going to stay similar to what it is today. Because if it goes much higher, then I would have been better off just holding Ethereum and it wouldn't make sense to be a liquidity provider. Now, if I think that Ethereum is going extremely down, I would be much better off just holding US dollars and not participating in any form of market making. But let's make the assumption that I believe that in the coming year, Ethereum will go down to 1,000 up to 4,000, but come back to this kind of 1,900, 2,000 price point that it is today. Now, during this time of the prices going up and down, I'm going to be able to get a percentage of all the trades that are being made in that specific pool. And these returns can get quite substantial. For example, most USD Ethereum pools in the new version of Uniswap, version 3, yield about 50 to 100% returns per year. So it really moves around your assumptions about the market, and it rewards you if you're right. It rewards you for making a good estimation and picking the right time frames and understanding what risks you're taking. So again, providing 50-50, we benefit most if this price that it is today is going to stay relatively similar, at least returns to this price point the moment we exit the pool. Now, more complex example of Balancer. So Balancer is not just a AMM solution, it's also a automated portfolio manager. And let me explain what it is and how it works. So in Balancer, you can select yourself what distribution you want of each asset. So let's take the example that we want 20% Balancer tokens, 50% Ethereum, and 30% Bitcoin. The reason why I'm doing this is because I would, for example, personally believe that this is the exposure that I want. I have a lot of conviction in Balancer, but even more conviction in Ethereum and some conviction in Bitcoin. Now, what the Balancer protocol would do is that it would automatically rebalance your portfolio. So let's say Balancer goes up for a lot. Let's say the price doubles. and the percentage of these assets then goes from 20% of my portfolio to, for example, 30%, it would automatically start trading and incentivizing traders to buy the balancer away from you in exchange for more Ethereum and Bitcoin. So it automatically rebalances your portfolio and you earn the trading fees from it. It's like in traditional finance, if you would combine an asset manager with an exchange. If you would combine a Fidelity with a portfolio management company. And this is truly revolutionary because now you have these assets that are not sitting still. You have a portfolio exposure, but it's also earning fees. And this is, again, the magic of DeFi. Because everything is connected to each other, you are able to get more yield, more utility out of these digital assets compared to their, let's call them semi-digital traditional alternatives. Now, AMMs have been around for a very short time, 1 to 2 years, but the next iterations are already here and they're more complex, more digitized, and also more automated. So I wanted to share 3 examples with you that I'm not going to dive super deep into right now, but if you're interested, I would recommend looking into them. The first one is something that was released on June 9th. So just 2 weeks ago, this was the white paper for the second Curve protocol. If you recall, Curve is optimizing for stable transfer. So US dollar to US dollar, euro to euro. But in this new method, they're changing the way that their function works. So the way the AMM works to also allow for non-stable assets. And the way they do this is by automating the trading fees. So making them dynamic. An algorithm does it, not humans anymore, but also making dynamic pool allocation. So it's no longer that I say, hey, I want 20% of this, 40% of this, and 60% of this. No, an algorithm will determine what the best amounts are. So it's really shifting away AMMs from something that humans need to do to make assumptions about where they see the market moving to something that an algorithm will do for them. Well, this is just a white paper, and it's still going to take at least 3 to 6 months for this Curve V2 to be realized. But it's really showing the pace of innovation in DeFi, where things just move at an incredible pace. A year in DeFi is almost like 20 years in the normal world. You may not see it, but I aged like 20 years in 1.5 years. Another concept that's really revolutionary is Uniswap version 3. It was launched on May 5th. It was specifically innovated in the area of focused liquidity. What does focused liquidity mean? Let me give you an example. So in this, in a traditional automated market maker, you provide trades at any price point. So you say, hey, I have these tokens available and anyone can trade them at any weight. So it could be 1 to 10, but if the prices move, I'm also willing to provide a trade at 6 to 1 or 4 to 1. This means that you're putting a lot of resources available for trades that are very unlikely to happen. It's very unlikely that 1 Bitcoin will be worth 1,000 Ethereum. So why provide liquidity for that specific price point? The way Uniswap changed this is that they allow people to specify within what range they're willing to be liquidity providers, which makes their liquidity more useful. It makes it more effective. So let's say I am willing to provide liquidity for Ethereum US dollar between $1,750 and $2,250 per Ethereum. Now, within that range, my position is going to be very specialized because I only provide liquidity for these positions. I'm cutting off all the things on the left and the right that I don't want to be a liquidity provider for, and that really optimizes for trading. This means that a amount of, for example, $100 million would be able to create extremely deep pools. And with deep, we mean that people can trade large amounts. So the deeper a pool, the more assets in there, the larger trades can be facilitated. Now, Uniswap v3 is another innovation, and that's the fact that in this third version, individuals can decide what trading fee they want to charge. It's recommended that for tokens that don't have the same price exposure, so if it's not a stable coin, you would charge 0.3 or even 1% trading fees in exchange for the risk that you're taking. Now, for a stable coin like US dollar to another US dollar, that's also allows you now in Uniswap v3 to charge only 0.04%, similar to Curve. And the final one that I wanted to mention is Balancer version 2. Balancer version 2 is the next iteration of Balancer, and it really continues to build on this concept of a automated portfolio manager. As in DeFi, you are able to actively utilize these assets, for example, providing it to a decentralized exchange or using it in any of these other use cases of DeFi like lending, insurance. What Balancer is building is a protocol that allows you to use the assets that are inside a pool. So for example, you could borrow out a percentage of the US dollars that's in your US dollar pool, because it's unlikely that all volume is going to be, that all the tokens are going to be traded at one point. So it optimizes and it allows you to earn more yields on a percentage of the underlying assets. That's what they call the vault manager. It also allows you to utilize these governance tokens in these pools to do voting, to vote on different applications, to vote on protocols. So it's really extending this concept of an AMM to much more than just providing trades. It allows you to lend, it allows you to participate in governance, it allows you to potentially stake, and it really enhances the ability of these DeFi applications to utilize these assets as effectively as possible, with the intention to make a more effective financial system, one that's more accessible, more secure, more transparent, and in the end will hopefully create a lot of value. And that's where we are with the DeFi fund as well at Icoinic. We believe that there is a lot of merit in this combination of utilizing DeFi assets and also participating in DeFi, participating in governance. Yeah, and I believe that we're just at the start of this. If you compare the current traditional financial system that has over 100 trillion in assets to the small 50 billion that's currently operating in DeFi, you can really see that this potential growth size is just immense, much larger than something like Bitcoin, for example, that is often seen as like digital gold. The market for gold is about 9 trillion. The current market cap of Bitcoin is a little under 1 trillion. So realistically from here, it's maybe only 6, 7, 8, 9 times up, where DeFi still has an immense of room for growth in the hundreds or even thousands times from here, if it actually manages to replace or take some part of this traditional financial system. So those were the basic introductions to AMMs. I think I went relatively deep already for a first go. I hope you were able to follow it. If you have any follow-up questions, again, the slides will be shared, but also now is a good moment to ask any questions you have. So Vadim asks, can we say that Banker is the first example of DeFi? What stopped it from being as popular as Uniswap? I think that's a really good question. So like I mentioned, Banker was the first project to introduce this concept of an automated market maker. Now, where I think that Uniswap, why and how Uniswap became more successful is specifically on two things. One, it's the simplicity of the application. Early on, no one understood what an AMM was, and Uniswap made it extremely simple. There are only 2 tokens that you can provide. It's always 50-50. You can't play around with trading fees. The interface was extremely simple. You could only basically do 2 clicks, and that was it. This allowed anyone to easily create a market. It allowed anyone to easily participate, anyone to trade, which has really paid off. Where Banker is a somewhat less user-friendly and more complex alternative. And I think the second part is just the, I don't want to say specifically community, but the culture behind Uniswap. The culture of Ethereum is very close to Uniswap. Vitalik Buterin, the co-founder of Ethereum, is very closely aligned with Uniswap. Uniswap was created in a Ethereum hackathon. So it has a lot of goodwill from the industry. And I think they've also really being able to leverage that, where a project needs to decide, am I going to use market maker A, Uniswap, or Balancer or Curve? Especially early on, Uniswap was just the go-to option because of not only the ease of use, but also the general acceptance in the industry. Where can I get more info about the Icoinic DeFi Fund? So the best way is to head over to our website, icoinic.capital. There is a page about the DeFi Fund there. You can request more information, and then you'll either speak with me or one of my colleagues, and we can walk you through. Any comment on Polkadex? So Polkadex is a decentralized exchange built on the Polkadot settlement layer. So if we go back to the slide where I walked you through the different layers of a DeFi chain, you would start with a settlement layer. In this case, it's Polkadot. On top of Polkadot, you have decentralized exchanges in the form of Polkadex, for example. Now, it's really important to understand the value of a settlement layer. There are a couple of things there. First, it's the security of a settlement layer. For extremely important transactions, you would, of course, want to use the most secure blockchain, which currently is Ethereum. Now, if you are doing smaller transactions, you may be okay with some risk that there's a minor chance that your transaction will be reverted or not processed correctly. So that's where you can look at alternative settlement layers. Polkadot is one of the larger ones. It's one that's actually quite developed. But the DeFi ecosystem on top of Polkadot is still small. So instead of having, let's say, 100 or 200 applications like on the Ethereum blockchain, there may be between 10 to 20. Also, the amount of assets living on Polkadot is much smaller than the amount of assets, both in value, but also in numbers, living on Ethereum. So the ultimate kind of benefit from an exchange like Polkadot, like Polkadex, is always limited to the value of that settlement layer. So it's really a question about settlement layers. Do we believe that Polkadot will be able to build a DeFi ecosystem on top of it that is as valuable or more valuable than something like Ethereum? In general, what we're seeing now is that a lot of projects are evaluating using multiple chains. So they don't just provide their assets on Ethereum, but they would also do it on, for example, Polkadot or Polygon, which is now called Matic, as a way to give users their own, give users the option to use the chain that best represents their values and needs. So for example, if you're trading $10 of Ethereum, you don't want to pay $5 in transaction costs on the Ethereum settlement layer, but you would be much better off using something that's a little bit less secure, less decentralized. So it has a little bit of a risk that your transaction would not be executed correctly, but it's almost a near free transaction. So if it's a $10 trade, you may be better off using something like Polkadot or Matic, where you pay 0.01 cent for the transaction and you're able to get the other assets. James says, can you give an example of DeFi being used outside of crypto trading, replacing traditional finance applications? I think stablecoins are the biggest example of replacing traditional financial infrastructure. El Salvador recently started accepting Bitcoin, which is of course quite interesting. But I think even more interesting is a country like Bahamas using some form of a stablecoin that represents the dollar. Bermuda is also doing it and replacing their traditional highly friction banking system. Again, I come from the Caribbean. I've experienced myself where the traditional financial system is creates a lot of friction for these smaller countries. It's hard for them to be connected to this global infrastructure. So there are already some smaller countries like Bahamas and Bermuda that are adopting some sort of a stable coin pegged to the US dollar and using that instead of the fiat alternative of a dollar. Now, that's step one. You have a country that allows or utilizes stable coins on a blockchain. But then the next step is these stable coins also give you access to these DeFi protocols on top of it. So it doesn't just give you a cheaper and more useful digital dollar. It also allows all your citizens to use decentralized exchanges to swap their digital dollar to a digital euro for not even half of the fee, way less than half of the fee that it would pay normally. It gives them access to markets that they've never had access before. Imagine someone from Trinidad or from South Africa now being able to purchase a derivative or a synthetic or even a stock of Tesla. They're able to lend and borrow with people all over the world. Now, of course, there are questions here about KYC and about regulation, how to best do this. But if you just look at it from an innovation perspective, it can really open up this long tail of financial users that are currently being excluded out of most financial applications. So Robert says, Curve sounds like the market effectively pricing credit risk between stablecoin makers. Is that a fair statement? Yes, and I think mainly yes. It is indeed the market pricing the credit risk between the different stablecoin makers, but it also has some degree of, there's also a large degree of users that are not as educated and work on pure need and pure utility. So to give you a good example, right now, there is some speculation, and it has always been, to be honest, for the past years, that the US Tether, the USDT, is not fully backed by dollars in the bank account, but by other assets, which may be more risky. But it's extremely hard for a market to evaluate what that risk is. So right now, in Curve, there's a similar distribution to, for example, USDC and USDT. So essentially, it should be like that, but as of yet, I don't believe it's truly happening. I think it's something that we're going to see in the coming years, that this market will become more efficient and become more smarter, especially as more educated investors and educated traders are coming into DeFi, that we will actually move to this kind of open space where these global markets effectively curate risks between different protocols. A question from Justin. What will the new EIP 15559 version of Ethereum have for influence on the DeFi sector? Nice question. I think really relevant for where we are today. So EIP 1559 is an upgrade that's going to happen to the Ethereum network. For the people that don't know, Ethereum is currently in its version 1, and it's moving towards Ethereum 2.0. It's moving away from its current way of settling transactions on the network. Currently, that's done by proof of work. You may have seen these minor applications, which are big farms of computers that are creating and helping secure these networks. Ethereum is moving away from that way of consensus to what we call proof of stake, where it's the token holders running nodes that secure the network instead of needing to run all these minor equipments, which have also been getting more and more backlash for the kind of environmental damage that they do by burning a lot of energy. I'm not saying that this is per se a correct statement, because if you compare it to having as a traditional financial system, having all these bank buildings, people work driving their car to the office, and if you take it all into account, then maybe the energy costs are still minimal. But what is happening now in this transformation from Ethereum 1 to Ethereum 2, there's this update called EIP 1559 that will standardize the transaction costs of a transaction on Ethereum. So right now they're quite flexible and variable. So one day you may be paying $50 and the next day you may be paying $10. And what EIP 1559 does, it standardizes this market. This market is called the gas market, so the market for executing transactions. EIP 1559 standardizes the market. It creates a more stable base price. So let's say 50 cents becomes the new stable price, and it can move up a little bit and down, but it's not going to move extremely volatile. It's going to standardize that, making it more and making it easier for application to estimate what amount of gas they need to pay for transactions. So increasing the user experience for users. They don't need to decide themselves if they need to pay a lot of gas or a little bit, which is the case right now. So it improves the user experience. But an extra side effect to it is that any transaction that wants to kind of pass the line and move faster will pay an extra fee on top of this kind of base price. And this extra fee does not go to the miners, but it goes to all the token holders. It's burned. And with burns, it means that it automatically is destroyed, effectively lowering the circulating supply of Ethereum. Something that they've spoken about in the industry a lot is this concept of super stable or hyper stable money. So if you have Bitcoin, the argument is always, hey, we know that there's going to be 21 million Bitcoin. So it's predictable how high the inflation will be. And therefore it's sound money. It keeps its value. But with Ethereum and with the IP 1559, when the usage is high and the issuance is relatively low, it's about 3 to 4% each year, it could be the case that the amount of Ethereum being circulated is actually going to decrease over time. So you get kind of the opposite effect of inflation. You get a deflationary currency, which is extremely valuable. You get something that becomes more rare over time, which isn't the case for Bitcoin. Bitcoin becomes a little bit less rare over time, but it's predictable, so it's safe. But if Ethereum is continued to be used as kind of a main settlement layer, then there will be a point where Ethereum will be deflationary, and where this EIP 1559 update, but also this transition to Ethereum 2.0 will truly create this global settlement layer that is increasing, at least decreasing in circulating supply. So there is potential that this is really going to shift the focus away from Bitcoin being a kind of good reserve asset to Ethereum being a better reserve asset. And as a relation of that, anything built on top of it and the financial infrastructure around it, which is DeFi, will also hopefully and most likely get an extra burst of attention from this kind of mechanism. But this is a mechanism that not a lot of people know about yet. It's something that's still in development, but the end of this year to early next year, all these updates should be in place, and EIP 1559 itself is already projected to go live about a month from now. Thanks for the question, Justin. Thank you so much for attending. If you're interested to know more about Icoinic, you can visit icoinic.capital. This webinar was hosted in collaboration with ITI. If you're interested in ITI, you can also find their information on our website or look them up on their socials and website. Thank you so much for joining. I really hope to see you again in the next DeFi session. If you have any questions, please don't hesitate to reach out.